Hello, world. Can you guys hear me?
I can hear you.
Yeah. What's up, folks? Starting soon. To the 4 people watching, appreciate you.
We isn't that the private chat? Is it just us 4, or is it 4 other?
Could be
folks?
the 4 of us.
It probably is the 4 of us. Man, we're so rusty with this live stream setup.
I was catching up with Thread Guy the other day.
Oh yeah.
I was like, dude, you are so native to this. I feel like such a boomer saying that. What's up, folks? We're live. What's up? What's up? We'll wait for like 2 more people to get in. Yeah, I was catching up with Thread Guy, and I was like, I just can't compete with you in the live stream game. You're built for this. You're a live stream machine.
I went on. Shout out to him because I went on his show like a week or so ago, and he has like a nice setup. He's like phantom neon lights, like this green, like looks like a putting green. It's kind of.
Yeah, I went on in July, and like I didn't really like know his like audience and like what the vibe of the show was, and I got hit up by a bunch of people, and they were like, "You don't seem right for Thread Guy," you know? and I was
Too
like,
much
and I enjoyed
hair
it
for Thread Guy, Rob.
Yeah, but I enjoyed it, you know. And then I think in the chat, the whole audience was basically like, "Who is this boomer? Like
what's the CA? What's the CA? Yeah.
What's a price target? You know, when you also go on Ryan's show, it's you know, I just feel like out of place.
Who's Ryan? Oh, Rand Nooner?
Rand,
yeah. Rob, dude, what's going on? How are you?
I am sleep deprived. I'm working a lot these days. It's good though. You rather be busy than not busy. And so like when the market comes to you, you gotta take a hold. You gotta take advantage.
Why are you so busy?
Well, I think as you guys know, the things that I focus on are a lot of the, call it like, you know, crypto, traditional finance crossover, payments, stable coins, traditional capital markets. And I think that part of crypto right now is just ripping at the moment. And we're just seeing a lot of deal flow, a lot of new entrepreneurs, a lot of people that are really excited about building in the space. We're also, you know, all of the DAT stuff. There's some work that, you know, we've been doing around that specifically. And so that's been, I think, taking up some time for me specifically. And I will say that there's been a lot of stuff happening in the DAT space because I got to be honest, there are so many people in this space who do not understand public markets. And they're just like doing some like wild west stuff that makes no sense. You know, I saw a wall cross script from one of these things that was like known falsehoods in the wall cross script. They don't like, it's just craziness.
Wait,
like,
what? Say what that means. Say what that means.
So when a digital asset treasury company wants to go and actually market the equity, and so they want to tell you like, okay, this is the public company that we're putting in a pipe into, or this is, you know, maybe the SPAC that, you know, is helping take this thing public. Because it is already publicly traded, they have to go through what they would call a wall cross. The wall cross has a certain compliance standard to it, and the lawyers actually agree on what the script will look like, so that when the bankers or the placement agent goes and they send that to potential investors, they make it very clear that they understand they're getting non-public information and that they will not be trading in that public equity. But there's a whole standard around the way of which you market these things for public company equities that has to be done. And the stuff I am seeing from some of the crypto natives, or like, you know, think that they're trying to make a bunch of money, is, you know, unsophisticated at best. And in many cases, just like, I got to be honest, just complete, just haphazardness, and you know, and put it the nice way.
Yeah. All right. Let's dig into that. So there's a couple things I want to talk about. One is World LibertyFi. Their token became tradable. There's some, I feel like, shenanigans that are happening there. There's Tempo. So Stripe and Paradigm just launched Tempo chain. I want to talk about that. I want to talk about stocks and crypto are really starting to converge. You had Galaxy listed on Solana. So Galaxy listed their stock on Solana. You had Coinbase do some crypto stock crypto convergence thing. So we'll talk about that. But maybe we can talk about DATs first. MNAVs are doing what I think we've been saying that they would eventually do on Empire for a little bit, and it's starting to happen, right? Which is the MNAV is going sub-zero on many of these. So I can pull up the chart.
Hopefully not sub-zero.
Sub-zero. Yeah, exactly. It's going negative. It's going sub one for many of these. So if we look at the Blockworks data here, the basic MNAV is 0.95, 0.91, 0.77, 0.89, 0.97, 0.93, 0.67. And you got a couple of these, strategies still at 135, game scores at 105. Some of these are still above 1, but a lot of them are sub 1 now. So
just to give you guys a little feedback on this, I think the ones you have here that are SPACs are wrong. Like the 0.11 from Ether Machine, I think they're actually trading at a premium right now. And the 21 Capital is the same thing, the 0.06.
You know what? I wasn't going to the right enough. I was looking at the basic MNAV. I should have been looking at the MNAV, enterprise value MNAV.
Makes sense.
Yeah.
But yeah, I mean, you're not wrong that the MNAVs are collapsing, which we expected. They're, for the best ones, the strategy is like, the maybe the Aspets, maybe 21, a few of these others that have really good management teams, have good capital structures that are able to continue to, increase that token per share and potentially also have, really good ways to interact with the ecosystems. Like they will probably do well, but do well means trade at like a really good REIT. And what is a really good REIT trade like? A really good REIT trades at 1.5 times its NAV, right? Or then, we saw some of those REITs when the in the data center REITs, when AI was really starting to pick up the pace, some of those traded up to, over 2 because there was so much excitement about AI. But these things aren't supposed to trade at 3, 4, or 5 times. And that's just not going to be steady state in any way.
Yeah. Santi, have you been paying attention to this or you staying out of it? You're muted, sir.
As I said, I have some exposure to some of these stats.
So you ended up doing some of them.
Well, I did Upexi way back, contributing cash, not in kind. So that was kind of the early ones. And then, so I'm naturally paying attention for the reasons that we've talked about it here. Even if you're not investing in DATs, it's one of those things where you have to pay attention. There was a good thread by Galloway's Capital. I think he's generally a smart guy that maybe we can pull up and
here it is.
Anchor the discussion around that. Again, we're not the point that Rob made, which I think is not just related to DATs, but just generally public markets. I think it's a theme that we should continue. Like if we think about the major themes this year, public markets are, because of the regulatory environment, clear more crypto in public markets, from the Robinhoods, Coinbase of the world, more public companies. So DATs obviously fit into that equation. And then we've kind of the lurking question that one might have is if some of these DATs that are poorly structured or trade really poorly because they have some debt and forced selling, how much of how much of contamination risk does that have? And I think it also fits into World Liberty to some extent, right? Because I've been hearing a lot of chatter around, that potentially being detrimental to crypto long term, potentially after 4 years. And so, anyways, back to this thread of Kevin.
So what's Kevin saying here for those who didn't read it?
Rob, do you want to go or should I go?
I didn't read this, so you please fill me in.
Yeah, if you want to pull up higher, I think you're
basically saying, I mean, I can skim it if you want me to and say it out loud. It's basically saying like some folks think that the DATs are the next Luna. It's not. Others are saying there's nothing to unwind. There is. Think carefully about the mechanics. You can skip this part. Basically says, imagine an underlying where the distribution of DAT holdings isn't as extremely skewed towards one mega holder. If there's one small handful of mega DATs for a single underlying, this becomes a prisoner dilemma coordination game where the good outcome is possible to some extent. At like 0.9 MNAV, it's conceivable that none of the players go for the ARB. But if MNAV drops to 0.5, now the ARB profits are much bigger and could outweigh the negative consequences of underlying market cap compression, reflexive selling, reputational considerations, et cetera, et cetera. So in other words, the gain in ARB value is individual while the compression of the underlying market cap and hence all DAT market caps for the same underlying is socialized. All else being equal, more big DATs is worse than fewer big DATs for this game.
Yeah.
So
I do think he said a lot there, some of which I agree with, some of which I don't. What I would say I do agree with is that especially when you go beyond, call it like Bitcoin, maybe Ethereum, you don't want a lot of DATs. You do want, call it, one per token for that, call it next group of people that you think are probably big enough. When you go beyond the 15th or 20th biggest market cap token, you probably don't want a DAT at all. It probably doesn't make a ton of sense for there to be a lot of liquidity in the open market. I think there is a lot more risk around like just liquidity fragmentation, but also lack of liquidity generally. And so you're going to see a lot more like volatile price swings that don't necessarily make sense. But like if you look at that group of, okay, let's go to the next group, whatever it is.
Rob, what is your threshold? Look, Solana, you have Sui, you have Athena, you have like, what is your threshold of fully diluted or circulating market cap for a crypto project to say, okay, it makes sense? Because you've seen like story protocols of the world also launch.
But did you see what happened with Story, right? How did Story get funded, right? There was a $360 million, I believe, in total value. I believe only 100 of it was in cash. The vast majority of it was bought from the founder himself, which looks a lot like, exit liquidity. And then NASDAQ has not allowed them to end up delivering the shares. Why? Because it was all in kind and they didn't get a proper shareholder vote in place, right? And what we're going to start seeing is these like listing rule problems.
Wait, I didn't know that, Rob. So what happened here? This is what I was seeing is like NASDAQ is now both exchanges are now tightening DAT listing positions, where it's like, I think I was just reading NASDAQ's where any in-kind contribution of digital assets, it's a long update. I won't read it here, but can you maybe give an update of what that really entails?
Yeah. So what it really means is most of these pipes into these operating companies. So specifically, so let's put away the SPACs for a second, right? But the pipes into the operating companies, they're doing these pipes with very little, if any, shareholder votes, and then often they're doing it with no shareholder vote. They're just maybe getting the majority shareholder or shareholders on their side, and then call it after putting the pipe in, massively diluting everybody. They're just getting those people additional equity to make them whole, and those people are giving the thumbs up and saying, "Hey, listen, we control the shareholder vote, so we're okay with this deal." But the problem is they haven't gone through the proper full shareholder vote where they have to go get a quorum of shareholders to say, yes, we want you to do this deal. We want you to, and there's a threshold for how much equity you can issue to be able, without needing that shareholder vote. Typically, usually it's over 20. It's between over 10 and 20%. What the NYSE and the NASDAQ have been saying is they've been saying, well, these deals as they've been done haven't gotten the appropriate shareholder votes, and so we are not going to allow them, especially if it's in kind. Right. So this is not the SEC pushing back yet. It's the listing. It's the exchanges themselves. And they're saying, we think that you need more appropriate shareholder governance before you go and take basically stuff a microcap company with a bunch of in-kind tokens. Like imagine you're an investor and I forget what this company did that Story put money, that the Story protocol one, was put money into. But imagine you're an investor in some company that is some of these are like cannabis companies or they're biotech companies. And then all of a sudden, and you're not, a large shareholder, you said, hey, listen, you're going to get diluted by 300% or 1,000%. And also now this entire company just holds this IP token and and you have absolutely no idea what's happening, right? Like that is clearly not potentially not good for that shareholder. So the NYSE and NASDAQ are saying, listen, you need to go through the right shareholder voting rules to be able to allow you to do this. And so what happened in the Story protocol deal is they didn't allow the company to actually issue the shares that the investor should have gotten, because they said you have not gone through the right vote now. So now what they're doing is they have to go through a shareholder vote. It's going to delay this for probably a couple of months. And it potentially could even cause an unwind of the transaction if they don't get that vote done.
Wait, but then how does this work? Go, Santi.
Well, I was just gonna say, you're gonna see more and more of this specifically, and this focus on shareholder governance at the exchanges.
That's a good point, Rob. This is something that I paid a lot of attention to. Is there a stated threshold for the locked portion?
So the threshold is 20% of the asset value in kind. But I believe what is happening is they are being more strict and giving kind of a discount to the locked in kind.
Right. Okay. Yeah. Because you could game it in some way.
Correct.
Yeah.
What? Yeah.
Wait. So then, what happens, Rob? Like, let's keep using the Story one as an example. What happens where Story, I think, just started buying on the open market. They just started their purchases.
I don't know where the purchases are, to be honest.
So maybe so like don't use the Story one as an example, but like what happens when, all right, so this thing gets cash and then it starts buying the token on the open market, but then what if there's an unwind? How does that work?
Well, then they would have to sell, right?
Then
So let's say that NASDAQ came out and said, actually,
a leading question. Yeah,
right.
A lot of these, the way it's structured, if you look at the docs, they spell this out, which is there's like a 90-day period, and if it delays after that, there's some sort of compensation or return kind of mechanism. On that point, Rob, I'm curious what you've seen on your side. If, for instance, there's an unwind and you invested in this cash, do you get back the cash? You get back tokens? Because then couldn't you protect it where if it doesn't get listed and if they end up buying the tokens, like you just return the tokens, returning kind versus cash?
So what most of them are doing, not all of them, is they're saying you have the right to receive your pro rata portion less expenses of the token that we bought or your cash, right? And so it depends on who your investor base is, right? But like if this thing unwinds, Andreessen will take their Story tokens back because they were already a large investor. And I assume, right, that they will take their Story tokens back. But call it, will some TradFi investor who maybe put some money into this thing want to take their IP tokens and figure out how to custody it? Probably not.
Right on. Yeah. But so I was having this long discussion with someone that was at a TradFi and now in crypto, super bearish on that. And they're like, I was in a pod with Avi, and he was like, well, this is good because hedge funds can't buy ETFs, which is not necessarily true. A lot of hedge funds can't touch tokens. My point was, couldn't you get it like a waiver? Or I guess the question is, out of all TradFi, is it still true that like 90+% of TradFi can't touch tokens? Or can they structurally buy tokens per their LP agreements? They just don't want to do it themselves and prefer to just buy stock.
I don't know what the but the vast but I would guess that 80% still cannot actually
on paper cannot touch tokens.
So it's a mix of two things, right? So one is it's a mix of, okay, my LPA doesn't allow me to buy tokens. In most cases, my guess is that the LPA doesn't actually contemplate whether or not you are touching tokens or not. And most of them, they really wanted to get around it, potentially could, right? But then it goes, okay, well, are we comfortable doing that or not? How risk on are we? Or do we think the LPs will come back and if they find out we're doing this, will potentially raise a fuss? But then it's also, okay, well, like, are we comfortable with the counterparty risk of, a BitGo or an Anchorage or a Coinbase? And a lot of people still are not, right? Like you and I look at those companies and we're like, okay, public company, I don't know what Coinbase's equity value is now, but, tens of billions of dollars, right? Like you would think that some people would be comfortable with that. And a lot of people aren't. They're still very concerned about it.
Yeah, for sure. I mean, even as a fund, right? I remember in my days of ParaFi, like it was always an issue, right? If you're an RIA and you're custodying like assets that are, you invested in a project, it listed, it's still not supported by a custodian like Anchorage. It's a challenge, right? It's sort of
it's definitely a challenge when you go beyond, Bitcoin, ETH, like,
yeah.
Right. And so like, when it also, a lot of it matters too. And people, I think, underestimate how big of an issue accounting is for these guys, right? And especially if you're a taker who is not, so a lot of the quantitative makers, like the Cumberlands or the DRWs of the world and the Chain Streets and, the Jumps and all these guys, like they've been working on this for a while. They want to get involved in every market in the world. They employ a lot of engineers if you're like, I'm just going to throw out a fund, I have no idea what they're doing, but if you're Balyasny, right? Or like you're one of these guys, like you don't employ, half of your employees as engineers who are like comfortable with like understanding how to operate, any sort of, wallet infrastructure that then integrates into, their, accounting system that they were sold by FIS. Right. Yeah. And FIS, like, they don't really know what they're doing there either. Right. And so it becomes, do you really want to like go through the headache for what would be probably a 1% position in the fund? Yeah, but if you can do it in an ETF or in a publicly traded equity and it works with everything that you have already, it's much easier conversation.
Yeah. I know we got to go through an ad. Who is the biggest winner in this game? Is it a Fidelity? Is it the New York? What is the biggest custodians in TradFi? Like
State Street, BNY
Mellon, or Fireblocks, Anchorages of the world, insurance company. Like who are the biggest winners if you take a view that like crypto is going to continue to proliferate into the mainstream?
I mean, I think it's definitely the crypto natives, right, who are the biggest winners because like, you have the tailwinds of like the whole market. I mean, Coinbase, clearly, like they're trying to become the everything app. They're trying to do a little bit of all types of different types of businesses. So I think those are the biggest winners, but is State Street also going to build a bigger business on the back of this? Like, absolutely. Like this is good for them. This is growth for them in a way that State Street hasn't grown in years.
Let's let's pivot. I want to talk about World LibertyFi. And on a semi-related topic, let's do a quick ad break and then we'll be back in a minute. In an industry as hectic, fast, and complex as ours, it's incredibly hard to get an easy, no-nonsense stream of what's actually moving crypto. And that's where the weekly CIO memo from Bitwise comes into play. The memo comes from Matt Hogan, Bitwise's chief investment officer. He's been on the show before, and he has this amazing ability to take the most complex topics and break them down with clarity. Trust me on this one, the Bitwise weekly CIO memo is really worth the 5 minutes of your time. Check it out at bitwiseinvestments.com/CIO memo/empire, or just hit the link in the description of today's episode to get started. Carefully consider the extreme risks associated with crypto before investing. Oh, quick ads today.
Quick ads.
Nah, not bullish. Damn.
Not of a bull market, not a bear.
Damn, I was ready to go get some water or something.
Wait, on the other side, maybe it's just you're making so much money now, Yano, you don't need to sell so much ad space.
We'll always be bullish lack of ads. Bullish unlocks, baby. Bullish unlocks. All right, let's look at World LibertyFi. So there's like two stories here, probably. One is like a story about World LibertyFi, and one is just a broader story about like the Trump's involvement in this. And we can go anywhere we want to go, or we can not touch the hot button. But basically, so World LibertyFi token began trading on Monday, I think it was. So it's World LibertyFi is World Liberty Financial, very associated with the Trump family and stuff like that. It began trading with 20% of pre-sale tokens unlocked, got listed on a bunch of things, Binance, Bybit, Coinbase, maybe, I forget where exactly it listed, but a bunch of the exchanges listed it, had like a $6 or $7 billion market cap, and it started falling. Volume is pretty big, couple billion in volume. A day later, which was, I think, Tuesday, they announced they were going to use trading fees to repurchase and burn the World LibertyFi tokens to obviously reduce supply, stabilize prices. Then you start getting these like big funds that say that they're investing more. I think there was one called Aqua One Foundation in the UAE investing 100 million. And then as of today, like an hour or two ago, they just said that, trying to find the headline, but basically they're blacklisting, I think, Justin Sun from being able to sell. Something like that is the headline. So Rob, Santi, thoughts on just like, I don't know, World LibertyFi in general? Like, I don't know. I guess my skin kind of crawls when I say, I'm just like, oh man, I'm not touching this with the 10-foot pole, but you know, obviously some people are making a lot of money on it. And I don't know, it just feels kind of like, well, it feels a little grifty to me, but
let's start objective and then introduce our own opinions. Like, what does this thing actually do for someone waking up? Like what's
it's primarily what World LibertyFi, as I understand it, and I've there's two things essentially, right? So there's the lending app, which is people call it a fork of Aave. I think as I actually understand it, they are actually just sitting on top of Aave.
Yeah.
So the Aave is actually, so it's not even a fork. Go ahead.
I think the Aave treasury got a decent amount of the supply because they sit on top. It's my understanding.
Yeah, they sit on top, right? It's not even actually a fork, right?
So you've got the World LibertyFi app. You've got a mobile app, right, where you can like deposit crypto. It's like it's a mobile app where you can do that. You've got USD1, which is the stable coin, and then you've got lend and borrow.
Yeah, so the USD1 is the one product that's live, essentially, right? So you can mint USD1 right now. If you're, I think Biko is actually the person who is minting it. And they've publicly announced that they funded the MGX Binance transaction in USD1. I think there's maybe been a couple other announcements specifically around USD1 and what them getting involved as kind of a funding partner for some of these deals. It's about 2.7 billion outstanding right now, of which over 2 billion of that is that MGX transaction, which I think after they funded the deal hasn't moved since then. Then they had originally, before USD1, they had, talked about the Aave kind of application, or the lend borrow application. The app is new. I guess it's going to be a direct consumer kind of crypto wallet. But I'm not quite clear on exactly, what it'll look like, or, what it'll offer and it will have, or when that will even come out. But I don't know, Santi, Yano, if you know anything else.
Look, I think it's generally true. Only in crypto do you see 3 people that are doing this full time struggle to articulate what an $18 billion project does. But look, I mean, of course, yeah, it's a wallet infrastructure. It's like TradFi meet DeFi. It has a stablecoin component. It has a wallet component. The the ticker? The World Liberty token is a governance token, and as you alluded to or mentioned, Yano, it will receive some fees from trading. So
yeah,
the question, I think it's if you work through like how are people valuing this, putting aside kind of the political affiliation or connection, would this be like competing against like Ripple is the comp? Because I think the way crypto markets trade is like you have Bitcoin and then you have Litecoin, and everything is a comp to something, right? And so what are people comping this thing to? Is it Aave or DeFi protocols? Is it more like Ripple? Coinbase?
I think it's a meme coin. I think it's a meme coin. I mean, okay. I think Hasib said it right. It's like World LibertyFi is a $22 billion token, 5.6 billion to the Trump family, with token buybacks, yet no revenue. You don't have to like it, but it's here. It's like, I think it's this, right? It's there's a New York Times article about just like how much of the token is owned by the Trump broader family and agencies, I guess I'd call it. It's like the Trump family itself controls about 22 billion of the World LibertyFi token, suggesting that its holdings as of Monday afternoon were worth about 5 billion, making World LibertyFi one of the most valuable Trump assets, worth far more than their real estate holdings.
I'm going to read to you a quote, which I tweeted about yesterday, which is from Russ Hahnemann from Silicon Valley Show, which is revenue? No. Why would you go after revenue? If you show people revenue, they'll ask how much, and it will never be enough. The company that was the 100xer or the 1000xer becomes the 2x dog. But if you have no revenue, you can go say you're pre-revenue and you're a potential pure play. That to me summarizes World Liberty and a lot of stuff in crypto and AI, which is you better off staying generalist. And this is a pure play on long stable coins, long DeFi, and long TradFi adopting crypto rails, which is Ripple. To me, the comp here is Ripple, and think how that's. I
wonder if the comp is just the Trump token. To be honest, right?
Okay, okay, because I looked at ladies and gentlemen,
it's 2x the Trump token right now.
I bought the Trump token, and I was public about it and whatnot. I don't own it currently. When it traded all the way up to $70 or whatever, my immediate thought was, let's go look at World Liberty because it was doing a pre-sale or and the terms were like very funky. It was locked, and then they like since I think revised. We should have Mike Dudas on the show because I think he kind of was participating in that, has some good insights, I think. But I didn't end up investing in World Liberty. I probably should have in hindsight, but nonetheless. That was like my comp.
I do think Dudas and the investors in World Liberty did make a lot of money.
So what happened is So a lot of people have the same, I think, thought process that you had, Santi, which is they put out, the announcement.
I think.
Yeah. But you probably had it first, but other people had the thought process as well. But I'm sure you had it first. But what they put out the announcement of World Liberty. This was last summer, right? And they said they were going to go raise $300 million at a $1.5 billion valuation. That $300 million got over the first few months, basically got like 40 to 50% filled. There wasn't a lot of excitement around it. I think it was unclear how close it was to the Trump family. A lot of people were, saying, "Oh, like this is what Barron's doing it," but not necessarily Donald, the president, or Don Jr. or anyone else in the family. And then immediately, what happened after the Trump token launched is everyone said, "Okay, this just traded at a $70 billion valuation, and there's still a bunch of capacity for WLFI at 1.5 billion." It immediately filled up in the next couple of days. They then opened a new tranche at a $5 billion valuation, and that filled up as well. We know that people like Justin Sun and others were a big part of that. All of the people who put money in either of those rounds made more than their money back just on the first unlock. So if you put money in that $5 billion round, when it launched at 30 and they made it tradable on the first, you could have sold your initial unlock of 20% for call it like 1.25x your investment. And so people did make money, but it was, I think, a flyer for a lot of people because you did have to KYC AML up front. And you had to pay for your own KYC AML up front. You actually, you had to put in your credit card, and you had to send in documentation to, some lawyers I had never heard of, and do this whole thing. And they were very unclear about.
The Trump family also own equity in the law firm that did all the KYC.
I don't know. But they also they didn't tell you up front what the vesting was going to be. They didn't tell you when the TGE was going to happen.
It was very. When did they define that? Because I looked at it when the Trump token launched, and it was not defined, and that was a big question mark for me.
It's still undefined.
Oh, well, okay.
Yeah, they announced that they were going to have this first unlock, but it is still undefined when the other unlocks will be. But they announced the token economics, who has what amount of the token, but they have not announced when all of the unlocks are going to be.
What? How does that tie to Justin Sun and him being his $100 million or so being frozen? Yano, do you know?
It was. I mean, he was just. I think he was the largest holder of World Liberty Fi. He bought the tokens, and then I think he started selling them or transferring them, and then they just froze his funds. So I'm pivoting us. We got to get some. We got to get some positive news and conversation. We're 30 minutes in. This is
just before you pivot us, just super quickly. There was also, I think it was Zach XBT put out a tweet that was basically we're watching the USD1 minting, and a bunch of holders of USD1 are buying WLFI, right? And so they, I think the implication is that the WLFI team itself was buying or trying to, absorb the sell pressure of WLFI. And the biggest seller was, of course, also the biggest investor, Justin Sun. And then it comes out super quickly that they, for whatever reason, froze his funds. So just an interesting tidbit.
All right, pivot. Positive news. We've got Stripe finally came public. So this, Stripe and Paradigm have been building this thing called Tempo for a while. It leaked a couple of weeks ago. Now Matt and both Matt Huang and Patrick Collison came out with their statements today. So this was kind of the announcement, the launch day for them. So let me just read a little bit from Matt and a little bit from Patrick's, and then I'd love to hear your take. This feels like the most formidable quote unquote corporate chain. Google also had theirs last week that we didn't even talk about. GUCP, I think it's called, or GC, Google Cloud Universal Ledger, GCUL, I think it is. So there's all these corporate chains, right? This feels like the most formidable one. Let me read Matt, and then I'll read Patrick's. Matt Huang from Paradigm, introducing Tempo, a payments first blockchain incubated by Stripe and Paradigm. As stablecoins go mainstream, there's a need for optimized infrastructure. Tempo is purpose-built for stablecoins and real-world payments. Skip. Tempo's payment-first design includes predictable low fees, payments gas in any stablecoin via enshrined AMM, payments-first UX, opt-in privacy, scale, 100K plus TPS, sub-second finality, EVM compatible, embedded financial payments, global payouts, agentic payments, et cetera, et cetera. Patrick Collison added to that. He said, at Stripe, we care about high throughput, low latency payments. As the use of stablecoins grows across Stripe, Bridge, and Privy, we found that existing blockchains were not optimized for them. So we decided to incubate Tempo in partnership with Paradigm. They also partnered with all these big companies, Anthropic, Deutsche Bank, DoorDash, Mercury, Nubank, OpenAI, Revolut, Shopify, Visa, Standard Chartered, et cetera, et cetera. 15-person team. Matt Huang's leading it. Gents, give me the thoughts.
This feels like the Libra announcement of the cycle, given all the partnerships. It's very interesting. I think it, yeah, exactly.
Yeah.
Look, I mean, I've said it time and time again, distribution is incredibly important. It's no surprise Stripe has incredible amount of distribution. They have all these clients, and they've been super bullish on, acquiring assets that position them nicely to transition into, leveraging stablecoins. And so I think it's a natural evolution. Like logically, if I were in their shoes, I would have done the same thing. Different perhaps than other corporate chains. Like maybe you should juxtapose this relative like Circle Arc, for instance. And there's, I think like that's, I'd like to just get your guys' thoughts. I think it's very different. In my mind, Circle Arc is bearish Circle because it sort of puts them in a weird position with their clients. In this case, Stripe already owns a lot of clients. And they're just rolling out this infrastructure. Like, why would you leak that value if you have all these customers on the fintech side and they're going to adopt stablecoins and use Bridge and use Privy? Why would you settle to, I don't know, some other chain if you can use your chain and they have, a ton of users and enterprise customers, right? So I mean, not knowing much about it, but there's a couple of things that you mentioned there about the features, which is, high throughput and all that stuff, but privacy, open privacy, that's something that I would be really curious of how that's going to work. But yeah, it's something that is probably not surprising for anyone, which is
Yeah. Rob, what say you, sir?
Yeah, I mean, I've been publicly saying for, a few years now that I thought that a lot of these, call it large companies and corporates were going to want to own their own execution environment. I think for a long period of time, that was really out of, the general mainstream thought process. I think we've got attacked by a bunch of people from a bunch of the different general purpose chains saying that for a long period of time. It's clearly now all happening and we're starting to see, right? So, obviously this is an L1, we're Circle building an L1. We're seeing, Robinhood build an L2. Okay. Well, so it's a different, way of which they thought about coming and building their infrastructure, but it's still that, hey, they want to own their own execution environment. They want to build their own product, like full stack, right? We're starting to see, people announce things. We saw like, Toyota talking about building an L1, right? There's like all of these corporates that are talking about doing it. It does feel a little bit like, okay, the Libra days or 2021, where we saw all of these like announcements. We'll have to see what actually gets launched, but I think the time is now. And when you have regulatory clarity on, if we get the Clarity Act or some version of that, we're going to see more and more of this continuing to happen. When you have the Genius Act, we're going to see more people wanting to issue stablecoins on public chain. And if you look at what Stripe has been doing for the last 9 months, 12 months, it was clear they were building a network, right? Like they acquired Bridge that can do the orchestration. They already have the merchant endpoints. They already have the ability now to issue their own stablecoin. They're also issuing their own stablecoin backed card. They launched accounts in emerging markets with stablecoins. They've acquired Privy to allow people to launch B2B2C accounts as well, right? And you look at it and you're saying, okay, well, they own every part of the stablecoin stack, from the issuing bank all the way through the PSP and the PayFac, and all the way to the end to the merchant. And the only thing they don't own is the settlement layer. So why wouldn't they own the settlement layer when they already are operating as a network itself? And it allows them to do things like opt-in privacy. I mean, there was a lot of things around the payment design that I think we've seen in a lot of these stablecoin chains, the low fees, the gas and stablecoins, payments first UX, whatever that looks like. But the opt-in privacy, that's the one people haven't really been able to solve yet.
Yeah.
And so I am really interested in what that looks like specifically, but this is not the end of these types of, corporate chains.
I want to just, the elephant in the room is for more of the crypto natives. The question is, how is this any different than a database? Because if it's, they talk about the validator set being, all these big companies. It is owned by Stripe, but it's a consortium. So of course they're going to push that narrative, which is, aligned with the crypto ethos of open source and permissionless, so to speak. But how do you guys think about the argument that like a Codex or like a more crypto native project would say, listen, you need to be Switzerland. You need to be public infrastructure with a token which allows you to monetize relative to the internet. Okay, like you get around that argument, but does that actually going to hold? Like if fast forward 5-10 years from now, like is that argument going to actually hold? Like what does that mean for Ethereum? What does that mean for all the other chains out there? And is there a version of this world where that doesn't matter? And you just have a chain like Stripe that they use their distribution and their muscle. And because I could imagine the crypto natives saying only Stripe customers are going to use this chain. And the reality is it might not be the case. So I'm curious to get your thoughts on how you guys think this is going to play out.
I think this is a line. I mean, 2025 is a line in the sand moment. And you're seeing, I think, in 10 years, it will be very obvious that there was crypto from 2009 to 2024, and then there was 2025, and then there was everything after. And there's a group of people that will be very upset about something like this because they're saying, why wouldn't you build this on Solana or Ethereum or because a chain that can't roll back your transactions or something like that. And then on the other hand, I'll pull this up. I was just looking through. You've got the CTO of DoorDash, the co-founder of DoorDash. You've got the COO of Shopify. And the reality is they don't really care about that. They don't really care about someone, maybe the ideology of someone who's building in crypto in 2013. They just kind of say what, Andy said, the co-founder of DoorDash, which is the pace of crypto innovation is incredible. We're ready to learn. We're ready to build. And Andy's not going to go build on some L2, but he will go build on Tempo. And this just, I think, increases the pace of innovation. You'll have people who are really, really focused on kind of the existing original ideologies of crypto. You'll have a group that's focused on just like pure speed and innovation. And I think both sides will make both sides better. That's my take.
Yeah, I think, listen, Shopify and Stripe basically made each other, or Shopify basically made Stripe, right? They were their first customer. They grew with them. It's clear that one of the things that they've done a very good job of today is they've gotten these CEOs that tweet about, Tempo. Do I actually think like DoorDash is going to build an application on top of Tempo? Like, absolutely not, to be honest. Maybe I'm wrong, but I would be shocked. But do I think they're going to continue to be a big Stripe customer? And does that mean that they will put flow on this chain if it makes sense for their merchants? Absolutely. Yeah. And I think this gets to Santi's point, which is distribution matters, that these Stripe already has these relationships with these customers. And if this is a better product for them, they will use it. And I think it's the same point that, maybe Santi, you were saying earlier, which is there's two things, right? So you mentioned Codex, right? Which we're an investor in, who is, and there's like Plasma, and there's a couple of these other like stablecoin chains who are saying, okay, well, we're, Switzerland in some way, but I don't think those guys, that's really what they're saying. What they are saying is we're building a better product. And if we build a better product, a payments product that utilizes a blockchain, that since we own the full stack, we're able to build a product that does meet those needs in the same way that you saw Matt talk about here, and things like opt-in privacy and programmable transactions with, a gas paid and stable coins, et cetera, then people will use it. And so like Codex, obviously it's not linked to, like somebody who has a distribution like Stripe, but they're also basically thinking about the world in the same way. But then to your point, then we get to Solana and to, Ethereum and to Sui and to Aptos and to all of these guys, right? That's different because they've really been pitching that you will, you need a general purpose chain with liquidity and users already to make it worthwhile for other people to do transactions on this chain. And that is clearly being disproven by the day, right? Or at least it's being disproven that the CEOs of these companies don't believe that. Maybe they will be, later be proven wrong, but they don't believe it today, right? And so when you look at that, that's, I think that has to be the concern, especially for people who don't have a robust ecosystem already. And I actually had a founder of a general purpose chain that, people love and has a robust ecosystem already, tell me this week that they're worried about the future of blockchains for general purpose blockchains, because they wonder if they need to be more opinionated about product. Do they need to build product? And that's where everybody's trying to figure out right now is, do you need to own the end customer? And I think we're at least seeing that probably that's true, or at least people think that's true in the near term.
User aggregation theory is not going to change anytime soon. Now, I know we got to go to ads soon, but I got to drop. And one question that I have for you guys, particularly you, Rob, is around this. So, like, say that Tempo works really well and Stripe accrues. You could be in a world where Tempo is worth more than Stripe equity today. Like, could be a $200 billion chain, and Stripe is right at 100. Solana, not to pick on Solana, NASDAQ on the blockchain, tokenized stocks. I know you want to talk about that, and I'm just going to set you guys up, and then I'm going to rage quit because I got to drop. What does that mean? Like, does NASDAQ then wake up and say, whoa, hold on, wait a minute. I'm not going to use Solana. I'm just going to go the Stripe route and launch my own purpose-built blockchain for tokenized stocks, and maybe partner with Superstate. Your point around product, Rob, we thought about it on the emergent side, which is how much do we build and how much do we partner? Like, maybe you own the execution layer, you own the user aggregation layer, and then the middle layer, you're open to partnering, right? But I'm curious, like, if you guys have an opinion on, like, what does that mean for NASDAQ on the blockchain? Is that going to be done by NASDAQ or won by Solana, who's been at it for a while?
Yeah, I mean, I think if I just said everything I just said, in the previous response and, changed it for NASDAQ, it would still be true, right? Control. Which is that, I think it is a really interesting point in time and line in the sand, I think, as Yano said earlier, for general purpose blockchains and how they think about serving corporate customers who potentially already own, a distribution channel that, they don't want to necessarily give up to somebody else, right? Yeah. I do think for NASDAQ, well, what is NASDAQ, right? It's an exchange that has a bunch of member institutions. That makes perfect sense for their own blockchain, actually, right? Because, like, you could think about a blockchain as somebody who has a bunch of member institutions or member applications, right, that serve their end customers. And, we were seeing, maybe not NASDAQ specifically, but like the DTCC, for instance, has been talking about like a tokenization standard that other people could potentially use to plug into them for tokenized equities. Well, will they maybe allow somebody like a Denari, who announced their own L1 on Avalanche, or, Robinhood, who's talking about doing it, settle to their standard? Maybe they will, but does it also make sense someday for them to say, well, we want our own blockchain as well? Maybe, right? And I think we're going to, learn a lot more. What I will say is not the vast majority of corporates will have no interest and are unable to roll their own L1. Like, that's just not going to happen. So they're going to either, do some sort of fork, or they're going to do kind of an out of the box, like, maybe a roll up as a service type provider, or an Avalanche L1, or, one of these guys, because they don't have Paradigm essentially doing all of the engineering for them. And so we won't see, I don't think we'll see a lot of L1s from these corporates.
Last question, I'll leave. Does that then mean invest in middleware? Invest in connective tissue, like something like Layer 0 or bridges or cross-chain communication standards?
Not financial advice, but it seems clear that we're in the unbundling phase, or the fragmentation phase. And when the unbundling happens, eventually some sort of rebundling happens, and how that rebundling does end up happening, who knows?
Yeah. Santi, no, you got to jump. Let's do one more ad break, and then we'll be back.
Have a good weekend.
In an industry as hectic, fast, and complex as ours, it's incredibly hard to get an easy, no-nonsense stream of what's actually moving crypto. The memo comes from Matt Hogan, Bitwise's chief investment officer. He's been on the show before, and he has this amazing ability to take the most complex topics and break them down with clarity. Trust me on this one, the Bitwise weekly CIO memo is really worth the 5 minutes of your time. Check it out at bitwiseinvestments.com/CIO memo/empire, or just hit the link in the description of today's episode to get started. Carefully consider the extreme risks associated with crypto before investing. Mantle is pioneering the blockchain for banking, a bold new category combining traditional finance with the power of Web3. With UR, the world's first on-chain money app, users can manage fiat and crypto side by side using a Swiss IBAN account in Euro, US dollar, Swiss franc, and RMB, all posted to the blockchain. Backed by the Mantle network, UR is the access layer that unlocks a purpose-built vertical platform for on-chain payments, trading, and asset protocols. All economic activity within UR will be captured by Mantle Network to further drive value to MNT token holders. Follow Mantle on X at Mantle_official for more. Corporate and protocol treasuries face a major challenge today. Cash and traditional instruments are losing ground to inflation. A new industry report from Liquid Collective and EigenCloud lays out the next evolution of the digital asset treasury, moving beyond just passively holding Bitcoin to actively making digital assets like ETH and SOL productive through liquid staking and restaking. For CFOs, DATs, and corporate treasurers, the path to integrating liquid staking and restaking should be risk managed and aligned with long-term strategic goals. The Productive Treasury Report outlines practical adoption and a forward-looking vision for the role of the modern treasury as a strategic enabler of new technology. Read the Productive Treasury Report today by following the link in today's show notes.
All right.
Back.
We're back. We lost one.
One man down though.
Yeah, we lost one. It's all right. Got the better crew here. We don't need Santi anyways. No, I'm just kidding. All right, let's talk Galaxy. So I want to talk stocks on chain. So there were three things that happened this week. One is Coinbase announced a product that gives you exposure to, I'm not sharing my screen, am I? Here we go. Coinbase announced I'll just read Brian's thing. We're launching the first U.S. futures that give exposure to the top U.S. stocks and crypto at the same time. We'll launch more products like this as part of the Everything Exchange. I would expect that we start seeing this marketing tagline show up everywhere, which is the Everything Exchange. I would guess Coinbase starts using it. I would guess Kraken starts using it. I would guess everybody starts using this. So that's interesting. Mag 7 plus crypto equity index futures coming September 22nd. All right, so there's that. Then we also had an announcement that I can't find, which said something along the lines of NASDAQ and New York Stock Exchange are reviewing whether or not you can trade tokens on the exchange. Can't tell if that was real news, fake news, or like what the second order impact of that actually was. But the real thing I want to talk about was this, Rob, which is Galaxy announced that Galaxy's Class A common stock is now on Solana. I think Alex Thorne, who's a stud, and also their head of firm-wide research, shared their take on it. He said, these are real Galaxy shares. These aren't wrappers. These aren't synthetics. These aren't shares in a foreign SPV. We're the first ever publicly traded company to tokenize our SEC-registered shares on a public blockchain. I think Exodus did it first, but Galaxy is second. So they partnered with Super State Funds. This is how it works, which if you just pull up Intangible Coins' Twitter, and you can see the thread. It's Alex Thorne. Basically said some DeFi companies and exchanges have tokenized U.S. listed equities without knowledge of or permission from the issuers themselves. Thus, all they can offer are wrapped equity structures, basically tokens that are shares in a foreign fund structure. Wrapped equity structures obviate the relationship between the issuer and the investor to the detriment of both, et cetera, et cetera. On-chain Galaxy is real Galaxy Class A common stock. If you hold the token, you own common equity in Galaxy, the same as if you bought our stock through in your traditional brokerage account. No publicly traded company has ever done this before in the US. Future of equity tokenization is native on chain. It's in the US, et cetera, et cetera. You have to KYC with Superstate to add your Solana address to an allow list. We haven't yet allowed for AMMs, though bilateral trades through allow listed addresses is possible today. We expect to allow on-chain Galaxy and AMM pools on Solana in the near future. The SEC is grappling with how to account for the existence of AMMs and other forms of DEXs. And it goes on. It's a really good piece. You guys should read it. It's a long piece. I won't read the whole thing, obviously, but good piece on Galaxy and why they did this, how they did this, why they chose Solana, big picture for on-chain securities. Rob, I would love to just get your take on, probably this news specifically before going on to the Coinbase thing.
Yeah. On this specifically, so I'll just put a disclaimer out there that I'm personally an angel investor or shareholder in Superstate. The Dragonfly funds aren't, but I am personally. I think I've long been a believer that this sort of like wrapped secondary tokenized equity conversation that we've had with like X stocks and even like a little bit of what like Robinhood has announced that they're doing, I don't think that really works. I don't think you get sophisticated market participants who can operate in the way they need to do appropriate hedging, to allow for appropriate levels of liquidity, to take risk, in 24/7 type markets that we're talking about here. There's a lot of just kind of inelegance in those structures where you're, potentially minting and redeeming from something that is, maybe an SPV that, exists in, some like lightly regulated jurisdiction that is then also have a relationship with a broker dealer in another jurisdiction. And you can only mint and redeem during, certain periods of time. And then, potentially there's this potentially like maybe it's like in some ways fully tradable on chain, but not on, and call it centralized exchanges, et cetera. And there becomes a lot of like dislocation and just friction in those markets. So I just don't think sophisticated market participants will participate in them. And we've seen that with like X stocks, for instance. They do a really good job marketing, but if you go and look at their DEX volume right now, it's like less than $3 million a day, right? So then you get to the Superstate and Galaxy announcement, which is, hey, like we understand that these wrapped versions, which by the way, being a wrapped version of an equity, that exists in a lot of markets, right? So things like ADRs or like ETFs are really just themselves wrappers. So wrappers by themselves aren't necessarily bad, but the way you do them, the amount of friction, the way that the market participants can interact with them relative to other assets or the underlying, that matters, right? And so when you have a natively issued primary issuance on chain, it opens up a new world because you no longer have all of this friction to go from tracking the underlying or keeping the underlying and having the legal exposure to that underlying and what you have happen on chain. And so that, I think, is the unlock for equities on chain. Because when you talk to the large, sophisticated market makers, you talk to the large, sophisticated takers who want to interact, that's what they are looking for. They want to be on chain. They believe if you want 24/7 trading, that you need to have an ability to manage collateral programmatically and in a way that can happen over the weekend, and it can do margin calls quickly when banks are closed, et cetera. And so if that is allowed on chain, then they want to be able to trade the equities on chain. That will open up new novel products. It will open up better securities lending. It will open up longer trading hours. But you need the primary issuance in my mind, and that's what this is. And so I think it's really exciting.
Yeah. It's something that I've thought about a lot as we think about like what the future of Blockworks. I mean, we're a few years away from an IPO, obviously, but it's like if we went public, what does that actually mean in this future? In this world where you have two markets now, right? You have the on-chain markets and you have the off-chain markets. Off-chain markets would be NASDAQ and NYSE. On-chain would be on a blockchain. It's like our buyers of Blockworks equity, there's probably more of them on chain, right? On Solana, on Ethereum, than on NYSE and NASDAQ. I'd have to go do a big road show. So it's like, could we just list our shares? You list on NASDAQ, but at the same time, you list on Solana, you list on Ethereum.
Yeah. Right? Listen, if you want a road show, you're going to get a bunch of traditional people to buy your equity. Don't play down like your ability to go sell some equity. But I think that's right. I also think, the interesting thing for Galaxy, and you're going to see this with, I think a lot more companies, is that they might start by saying, okay, well, we're going to do a traditional listing, but we'll put 5 or 10% or 1% of our float on blockchains. And that actually allows for really interesting like ARB to exist between the two. Right. And so I think we're going to see a lot more of that. And that's what's happening here in Galaxy. Yeah.
Well, say more about the ARB.
Yeah. So right now, what you see is there's like a lot of dislocation. You keep using X stocks. There's a lot of dislocation between the off-chain and on-chain asset. That's fine, right? Because that's kind of meant to exist. But that has more to do with the friction than anything else. Because it shouldn't actually be happening in that case, because your legal right in the X stocks case is to get the equity back at the price the equity trades off chain. So if it's on chain, there's like this location. But if you do primary issuance on chain and off chain, then what you have is you have actually two different securities that can trade at a different price and don't have like a legal right to each other to track each other's price. Right. And so there's actually times in which like, and you see it already, right? So on a weekend when there's like macroeconomic data, Bitcoin trades up or down, and then the market's open and the futures open and like the markets go trade up or down, right? You'll start to see that happening between these two different products in a much more interesting way that doesn't have to track each other in the same way because they're not legally linked.
Yeah, that's a good take. Yeah, I think what you'll end up, you know how right now you so like if you IPO, right, you have to give you allot a certain number of shares to each person and to different platforms, right? So like Robinhood has been an interesting one to watch. I was looking at Bullish, who just the crypto exchange who IPO'd. They gave an outsized number of their shares to Robinhood. Now there's probably a couple strategic reasons that they did that. But when you IPO, you allocate to different groups, and existing investors get some, and new platforms get some, and things like that. Your banker at JP Morgan gets some. This will probably be just part of the mix. Is you'll say I'm giving 2% to Robinhood, 5% to my the head of listings at JP Morgan, and 6% to Superstate to go put it on Solana.
Yeah, I mean, I think this will be for all of the crypto companies. My opinion is they should be doing some, small portion probably at first, but some portion of their shares to, on-chain and some portion off-chain.
Yeah, that's a good take. I like that. So Coinbase rolled out this thing. I'm guessing right now they're essentially operating as a broker, right? They're operating in the exact same way that Charles Schwab and TD Ameritrade are operating. Do you think that model exists in perpetuity where they're basically just a broker on these stocks? Or do you think the stocks ever I'm trying to use the right words here, but like move full time onto Coinbase or on chain?
Well, Coinbase is never going to be an equity exchange.
Why not? Just because you just can't get that as the...
Yeah, they're not going to replace NASDAQ and IC, right?
But could you get another license? Like there's been new licenses that have been issued for, I think Eric Schmidt tried to create one, like the American Exchange or something.
Yeah. So when I say never, it's not that they couldn't try to go get regulated. It's that then you have to do things like compete for listings, right? Yeah. And it's just like a whole brand new business that I actually don't think benefits them.
Like why get into that? Just be a broker.
Correct. Just be a broker dealer, be a member. Like that is fine, right? I think in the announcement that they're actually said they're doing derivatives though and not spot. Right. And I think that's because they don't have the right regulatory licenses to do spot. But regardless, and typically derivatives are easier and it's easier to go through the regulatory process there. I'm sure they'll try to get spot eventually. But regardless, I think your point that you made in the beginning around, okay, well, everyone's going to be the everything exchange or the everything app. Like you're completely spot on, 100% correct. Every single crypto exchange or broker is saying, how do I offer all different types of products, all different types of assets? And how do I do it in one place?
Yeah. Yeah. Anything else on this?
No, I don't think there's anything else to talk about here.
Yeah. One thing I was thinking about just following up on that corporate chain, the Stripe thing is I think as these corporate chains start emerging and basically it's incumbent. There's a battle between startups and incumbents. Startups need to get distribution before incumbents can figure out innovation. As the corporates are now, 15 years into crypto, they're finally figuring out the innovation. Took them 15 years. That's about kind of maybe what you'd actually expect. They're coming in. They'll actually, I think, do pretty well. Unlike when they tried to get in 2017 and 21. I actually do think they'll start to do decently well. I think what it'll do is push the risk. The way to compete in crypto is you need to keep pushing the risk spectrum. So I know people don't like the meme coin mania and all that kind of stuff. But like, if you are crypto native and coming up, the way to beat the incumbents is to push the risk spectrum further and further. More trading, more degeneracy, more perps, more threading the line between what is legal and what is not, candidly. Because that's the way you compete with something like Tempo. That's my quick. I need to think about Tempo. It just came out this afternoon. I need to spend more time thinking about it, but that's my quick take from our conversation.
The history of startups is littered with startups that took reg risk or took legal risk or took some sort of risk to go and compete, right? I mean, even like Revolut, which is now a regulated bank, they basically went and took a really novel reading of the banking regulations of the time using like a Lithuania license that probably didn't allow them to do what they were doing and they went and grew into, the behemoth they are today. And then they went and did it the right way, right? Like that's not a new story. And I'm sure it'll be a story on blockchain as well.
Yeah. Yeah. Rob, anything else, man? You tired, sir?
I am tired.
Dude, it's lock-in fall, baby.
I know. I've got to sleep better. I've got to look as refreshed as you do. Like, you look great.
Trying, dude. Try moisturizer.
I need better. I need I need some sort of face cream in the morning, and my wife actually tells me that all the time. So
that you need moisturizer?
Yeah, I need some sunscreen.
Dude, always trust wifey. Content Rex.
You go first.
I'm my second pass at reading House of Morgan, which is a beast of a book. I made it about 3 chapters last time because I just got too intimidated. I'm a slow reader, so taking my second pass. I'll update you guys in like 4 months when I get through it. But House of Morgan.
Okay.
You know what it was? I listened to Jamie Dimon on. I went to the Acquired podcast. It was like a live podcast. Jamie Dimon did it, and he just talked about kind of the history of JP Morgan. And I was like, wow, I spent a bunch of time reading about the Gilded Age and did a bunch of Gilded Age books and and everything from reading about like Grant to Lincoln, kind of like really early, kind of kicking off Gilded Age post Civil War stuff into like Rockefeller, Carnegie, Vanderbilt, and then the last big one is Morgan. So that's my project for the fall.
All right, I'm excited for it. I'm going to say 2 things. First is, did you watch my Ohio State Buckeyes on Saturday?
I was thinking about you. Yeah.
Thank you.
Let's go. Yeah, let's go.
Go Bucks. The also U.S. Open week. Like I think my TV, if it's on from the U.S. Open.
Djokovic Alcaraz coming up tomorrow.
3 p.m. tomorrow. I'm going to the Open tomorrow night, and I was looking, and I was like, I can't really go to 3.
No,
I'm going to miss it. I'm going to see Sinner run through the 25th ranked guy instead.
Yeah,
so.
Yeah, tough.
Bummer.
You buy the tickets or you get the invite?
I got the invite from somebody else. So.
Let's go. Tickets are insane right now.
Yeah, I think the tickets that we have probably cost thousands of dollars a piece. So thank you for my benefactors.
Yeah.
And so that's the big one. And then I haven't seen it yet, but I'm going to give you a movie that I'm excited about as the fiction guy on the podcast. But House of Dynamite, it's like a political thriller. Catherine Bigelow, it's her newest movie. Really, it's kind of about how the U.S. government responds to a nuclear missile attack. Not a lot out there about it, but I see everything Catherine Bigelow does, so excited about it.
All right, let's go. Thanks for listening, folks. Good to see you. Enjoy the U.S. Open. We'll see you Monday.
Thanks, Yano.
Cheers.